euro area economy has now been growing for 5 years, and we expect the expansion to continue in the coming years. We've recently seen a loss of growth momentum. In both of the last 2 quarterly ECB growth projections, our staff has revised down its estimates. Actual data have also been weak. The flash estimate for euro area growth in the first quarter was just 0.2%. The slowdown has raised questions about the strength of the growth outlook, and in turn, whether the ongoing convergence of inflation towards our objective will be sustained. I would like to address these questions in my remarks this morning. The key issue at stake is as follows. Are we witnessing a temporary soft patch or a more lasting deterioration in the growth outlook? There is certainly no reason why the expansion in the euro area should abruptly come to an end. A gradual slowdown is normal as expansions mature and growth converges towards its long-run potential. But the expansion in the euro area is still relatively short in length and small in size. Since 1975, there have been 5 periods of rise in GDP in the euro area. The average duration from trough to peak is 31 quarters, with GDP increasing by 21% over that period. The current expansion in the euro area, however, has lasted just 22 quarters, and GDP is only around 10% above trough. Just as a way to compare, the expansion in the United States has lasted 37 quarters, and GDP has risen by 21%. In light of this, it is important to understand the sources of the growth slowdown we have witnessed this year. At present, there are 2 main sources. The first is one-off factors, which have clearly played an important role in the underperformance of growth since the start of this year. In the first half of 2018, weather, sickness, and industrial action affected output in a number of countries. And in the third quarter, we saw a significant disruption of car production created by the introduction of new vehicle emission standards on September 1st. Production slowed as car makers tried to avoid building up inventory of untested models, which weighed heavily on economies with large automobile sectors, such as Germany. Indeed, the German economy actually contracted in the third quarter, removing at least 0.1 percentage points from quarterly euro area growth. But this effect should be temporary. As the testing backlog clears, car production should return to normal by the end of the year, and the effect on output should dissipate. The latest data already show production normalizing. The second source of the slowdown has been the weaker trade growth, which is broader based. Net exports contributed 1.4 percentage points to euro area growth in 2017, which was, from this viewpoint, pretty an exceptional year. While so far this year, they have removed 0.2 percentage points. World trade growth decelerated from 5.2% in 2017 to 4.6% in the first half of this year. We are witnessing a long-term slowdown in world trade. Some of the factors that previously drove its rapid expansion, such as trade liberalization and the creation of global value chains, have waned since the financial crisis. We're also witnessing a cyclical correction from the very strong trade growth recorded last year. Trade dynamics are now normalizing as global growth retreats towards potential. Insofar as world trade stabilizes at lower level, its drag on growth could also be temporary. But there are two other conditions that could make it longer lasting. The first is trade uncertainty rises and dampens euro area export performance, in particular owing to protectionism. The preliminary trade agreement reached between the US, Canada, and Mexico reduces some of this uncertainty, but other disputes remain. Some indicators suggest this is feeding into the trade outlook. The manufacturing PMI for the euro area fell to the two-year low in October, with export-oriented economies recording particularly large drops. New export orders contracted for the first time since 2013. The second condition is if uncertainty about external demand spills over into domestic demand through confidence and investment channels. But for now, there is little evidence that the moderation in growth has affected business investment. But there is some evidence that those euro area firms that are most likely to be affected by the proposed tariffs have reduced their rate of capital spending. Moreover, the slowdown in imports has particularly affected capital and intermediate goods, which might signal that firms are scaling back their investment decisions. So we need to monitor these trade risks very carefully over the coming months.